And you may pick up something that somebody else doesn't, and that really helps us all to learn from each other and become better as traders together. And now, without further ado, enjoy this incredible trading. Until next time, trade super.
Jack Schwaker, renowned Market Wizards author and Traders Hall of Fame award winner, presents The Winning Methods of the Market Wizards, a powerful workshop highlighting the most common traits and techniques of the super traders.
Thank you. It's great to be in front of a crowd of which is almost pure traders, I would assume. First thing I want to say, even though most of you are traders, I assume probably a lot of people here do something else in their for the regular profession. Also, probably some spouses got dragged along unwillingly. So to make this talk relevant, I can assure you that all the points I'm going to talk about, really all the points, apply not only to success in trading, but to success in general. So that's the first thing. Now we'll start out with what's not important, because people think that trading has to do with some sort of secret formula, some magic, whether it's Elliott or Gann or anybody else. You find a formula and you'll get rich, and that's what success in the markets is about. And I think it's really a very wrong way of looking at it. And let me illustrate it by giving you a couple of examples to make it absolutely clear. We'll take some individuals. First, we'll start with Jim Rogers. Most of you, I assume, know Jim Rogers, the fellow with the bow tie. Used to work with George Soros running the Quantum Fund back in the 70s. It was the most successful fund at the time. He quit because he got tired of the management aspect. He's been investing his own money for the past couple of decades very successfully. Brilliant guy. If you read my interview with him back, which was done now about 13 years ago, all of his projections were exactly right. He was talking about the top of the Japanese stock market right before it topped. He talked about it going down, the Nikkei going down from 30,000 plus at the time. He said it would go down to 10,000. Incredible projection. He talked about gold at the time going down for the next 10 years. Every projection you look at, he was exactly on. Okay, so he's basically a fundamental analyst, but I asked him, Jim, you ever look at charts? And he says, like he's admitting a sin. He says, you mean if I just look at it just to see where the market's been? Yeah, I'll look at it. But do I believe in any of this head and shoulders, mumbo jumbo garbage? No, it's all nonsense. And he says, I've never met a rich technician. And then he pauses to be cute. He says, unless you count the ones that sell their services. So I don't know if you can get more cynical. I don't know if you can get more cynical about technical analysis than Jim Rogers. And for Jim, a short-term trade's like 2 years. Okay, that's one side. Other side of the fence, take Marty Schwartz, who's a stock index trader. I interviewed Schwartz. It happened to be coincidentally just the time he was putting together a track record. Now, a lot of these traders, they trade their own money. You don't actually get the luxury of having their track record per se. In this case, he was thinking of managing public money, so he had to have an audited track record put together. She gave me his 10-year track record when I was doing, before I did the interview. And over that 10-year period, Marty had compiled an average return of 25%. Now, usually I say that, the audience doesn't seem to be very impressed. So let me clarify that. 25% per month. All right. Now I've got your interest. Okay. Now, some of the quantitatively oriented people in the audience are going, wait, 25% a month? How come you didn't own half the US JNP? Right? That really compounds. Well, Marty's father went through the Depression and instilled in his son a great fear of things going wrong. So Marty, even though, and this you can go back, you look at he was doing these trading contests with real money, not these hypothetical contests. He's putting in $400,000, turning it into $1.2 million in 4 months, going back, putting the profits in T-bills, going back to 400. He kept on doing that for 10 years. He kept on going from 400 up to over $1 million and back down to 400, and kept on putting the money into T-bills because he had this fear of something going wrong. So that's why he still made a lot of money, but it didn't compound to God knows how much. Anyway, Marty, talking about technical analysis, is paraphrasing people like Jim Rogers. And he says, I never met a rich technician. What a stupid, arrogant type of attitude. He said, I spent 10 years on Wall Street as a fundamental analyst. I lost money every year, and I got rich as a technician. So you really can't get much more different than that. And I'll give you another slant like Marty Schwartz. And this is a fellow by the name of Ed Seykota, who would be totally unknown were it not for my first book. I had never heard of him. The way I found Ed Seykota was there was a fellow by the name, also not a well-known, not a completely unknown person, not only well-known, Michael Marcus, who's a very private individual trader, who I happen to know Actually, just by coincidence, my first job in Wall Street as a research analyst happened to be the job slot he was vacating. And so we met, we became friends, we kept in touch. And so years later, when I was doing the book, I asked him to do the interview. Why did I ask him to do the interview? Because, well, he went off to be a trader. He went to Commodities Corp. They gave him a $30,000 account. 10 years later, it was $80 million. So that's why I asked him to do the interview. Now, so that's a pretty impressive record. And he was really reluctant to do the interview. And finally was able to convince him to do it. And I flew out to California and interviewed him, spent the day at his house. We really interviewed all day long. And after dinner, he pushes back his chair and he says, this really wasn't bad. It was kind of a cathartic experience. And he says, you should interview Ed Seykota. I said, Ed who? He said, Ed Seykota. I said, who's Ed Seykota? Well, he said, Ed is the best trader I know. Now, if you're doing a book on traders and some fellow who's turned 30,000 to 80 million is telling you about the best trader he knows, obviously you're interested. So I said, well, can I speak to him? So he says, well, sure. So he calls Ed and talks to Ed and gives me the phone. I was supposed to head back to New York, but Ed agrees to do the interview. So I say, well, I'll change my plans. I fly out to Nevada. And my original intention was to actually get back the same day, but it turns out I ended up spending the night there and just talking to him all evening. But in any case, Ed Seykota and I kind of see each other every number of years. We end up in the same place. And back about 5 years ago, we were both in Chicago at the same time. We had dinner together, and he was telling me tongue-in-cheek about a dinner he had the previous evening with a fundamental analyst. And he says they went to one of those Chicago steakhouses, the ones with the big steaks and huge knives. And the fundamental analyst is cutting his steak, cutting it a little too aggressively apparently. And the steak knife flips out of his hand, twirls in the air, and they're both watching and lands in his shoe. And Ed turns to the guy and he says, why didn't you move your foot? And the fundamentalist looks back and he says, well, I thought it was going back up. Okay. You get the idea. Cynicism, right? So what I'm trying to do, I'm trying to give you people here who are phenomenally successful using pure fundamental analysis on one hand and complete disdain for technical analysis, and people who have been enormously successful using pure technical analysis and complete cynicism about fundamental analysis, right? So you can't get further apart. It's got to tell you one thing. It's got to tell you there's no single way, there's no single road, there's no single message. If you're looking for that, you haven't even got the right question, let alone the right answer. So I'm going to quote myself. I don't quote myself very often, but I will for one time in this talk. And in one of my books, I used the line because I think it applies to this. And I said, there's a million ways to make money in the markets. And they're unfortunately all very difficult to find. But there are many, many ways. So the first thing to realize is you have to find a path and not to find the path. Okay. That leads us to the first principle. And if you take nothing else out of this talk, if you just take this out of it, it'll be worthwhile, I guarantee you. And that is every trader I ever interviewed, I could say this about. They found a method that fit their personality. Now, some of you may say, well, doesn't everybody do that? I mean, it seems logical. Wouldn't you trade your own? Well, no, you really wouldn't. Think about it. If those are your traders, you probably could think of examples right off the bat. But I've known certainly traders who may have had, let's say, a good knack analytically and could have done really well putting together some systematized approach and traded it, but no, too boring. Or no, they have to second guess it. Or no, they have to be more involved. Or it's too slow, or whatever. Or you have traders who are really good on the floor. They got the real instincts, but they get tired of all these fellows up in the office trading 10 times as much as they are in all these markets, so they want to be one of those guys up in the fancy office and so on. And they go do that, and they become a mediocre trader off the floor. You constantly have people doing things which are not fitting to their personality. Now, let me illustrate what I mean by trading to fit your personality. Again, let's take specific examples, specific people. First, we'll take Paul Tudor Jones. Paul, one of the great future traders, of our time, and particularly in his initial years when he was managing small amounts of money, just had some incredible, a decade, 10, 15 years of incredible performance. When I interviewed him, he said, come to my office at 2 o'clock, And I said, I knew he's an active trader, so I said, well, Paul, I can come after the market closed, no problem. He said, no, come 2 o'clock, it's fine. Okay, come to his office, big office, screens all the way across the walls, He's got speaker phones that directly connect to the floors. He got regular phones. He got people bringing him messages. He's yelling out, sell 300 March S&P, buy 500. All the interviews, selling and buying, and people, and phones are ringing, and everything's going on. He's looking at the screens, and he's doing the interview, okay? So I kind of say, like watching Paul trade is sort of like watching a professional tennis player on speed or something like that. I mean, he's just like really active and aggressive. That's Paul. That's his style. That works for him. Let's take another picture. Gil Blake. Gil Blake is a mutual fund timer. When I interviewed him, he had a 12-year track record, average returns of about 45% per year. Very steady. His worst year was like plus 35. His worst was plus 35. His best was about plus 55. Never lost more than 5% from a peak to a valley. Very, very consistent trader. What did he do? Interesting way he got into the markets. He was a financial officer for a firm, knew nothing about trading or investing, and a friend of his came in one day and said, "Look, Gil, I found this. I've been timing mutual funds, and I've got this little pattern that I found, and it works." And Gil says, "Nonsense, nothing that simple is going to work. Give it to me." And so he took the numbers and he went over it, and it worked. He couldn't find anything that was really wrong with it. And that got him intrigued. Then he started really looking at it more closely, and he came up with patterns that were really much more effective. And he became so convinced that there was something there that he quit his job and he became a trader, which led to the performance record I told you about. He would go to the library. He didn't even use a computer to do his work. He would go to the library, look through microfiche, look for all these mutual fund prices, and look for patterns, and just spend weeks in the library just flipping through these price patterns. Now, and he'd go back and he'd be trading out of his bedroom at home, and that was his style. No other people, no other phones, no computers, nothing. That's Gil Blake. Now, could you picture Gil Blake in Paul Tudor Jones's office? Could you picture Paul Tudor Jones and Gil, going through the microfiche? I mean, it just is such a contrast. And if either one tried to do the other, they would absolutely fail. So you have to find a method that fits your personality. That message, by the way, also leads to an interesting tangential observation. And it's why most people will be doomed to fail trading a system they bought. And if there are vendors here of systems, I apologize, but it's a reality. Now, why is that true? I don't know what percent of trading systems are profitable. Maybe, I'll grant, let's say even more than 50% are. Let's just take that as an assumption. The trouble is this: every trading system, I don't care what it is going to hit periods where it's not going to do well. Now, if you buy a system, particularly if it's a total black box, and you don't know what's in it, you didn't develop it, it has nothing to do with your personality, the first time that it hits a bad period, you're not going to have faith. You're going to lose it. You're going to drop it. And that's why invariably most people who buy systems end up losing, because they will stop using it when it goes through a bad period. It won't be there when it recovers. Again, it has to do with trading what matches your personality. There is a Wall Street adage that goes something along the line: even a poor trading system could make money with good money management. Have you heard that before? You got that? Okay, if you have that, forget it, because it's really one of the stupidest things that has ever been said. Okay, I'll illustrate that. If you believe that, then I invite you to go to Las Vegas and go over to a roulette wheel and use your best money management system and see how far you get. And in fact, if you were to ask 100 mathematicians the following question: I'm going to play roulette, what betting strategy, what money management strategy is going to be optimize my results? They all should give you the same answer. You know what the answer is? Let's say you have $1,000. You walk over to the roulette wheel, pick red or black, put it all down, bet once, win or lose, walk away. Those are your highest odds. Now, yes, they're less than 50-50, but only a little bit. But the longer you play, the more your odds go down. So if you don't have, and here's the point, if you don't have the edge, good money management is actually the epitome of bad money management. You actually bet it all at once, because anything else you lose, you have a higher and higher probability of losing. So it's not enough to have money management. You actually do have to have an edge. And having an edge means that you have a method. No trader I ever interviewed, when I asked them, how do you do what you do? Some explain it actually very, very explicitly, some more generally, but they all have some specific type of approach. No trader ever said, well, I wake up and I look at the screen and if bonds look good to me, I'll just buy them. I mean, nobody had a cavalier shoot from the hip approach. They all had specific methodologies. That's essential to a winning approach. The next thing we come to is the concept of hard work. It is amazing how workaholic-like these people are as a group. And I can give you lots of examples. In fact, most of the people would fall into the category. I'll take one example out of the most recent book, and that's David Shaw. Very secretive fellow who runs this hedge fund, which is a statistical arbitrage, I guess, to put it into a category. What they're doing essentially, and he's been running this fund now for about 13 years, excellent results. And what they do is they trade literally about 10 different all the major world markets. They're monitoring all the equities, all the derivatives, and they're running about probably 20 different mathematical models simultaneously and looking for tiny mispricings, and it's all working interrelated with tremendous computer power. He has scores of the best PhDs in mathematics and physicists and computer science working for him. It's an incredibly complex, sophisticated approach. I mean, extraordinarily so. You would think that monitoring this and supervising this and working on this would be enough, but no. David Shaw, over the years, has also been developing companies. Probably one of the better, I mean, quite a number of them, which he then spins off and sells. Probably the best known one is Juno, which is the website which he sold off. And he sold another one off to Merrill Lynch for their computer trading department and so on. And if that's not enough, he's got a hobby which is applying computer science to development of drugs. And so he's got two companies where he's involved heavily in that, and he's reading all the periodicals in that industry. And if that weren't enough, when Clinton was president, he was advisor to Clinton, and he chaired a committee on education and science. And you think, and I asked him if he ever takes vacation. He says, well, not really. And if he does, he gets, after 3 hours, he has to go back to work. That's David Shaw. And he's really kind of typical of the person that is really successful. And I said there's really lots of types of examples. I'll give you another example. John Bender, who's an options trader I viewed in the last book. He would be trading options both in the U.S. markets and the Japanese markets, and he would be up and trading and watching both of those markets. So, and they're completely different. They're 12 hours apart. So, you figure out when he sleeps and does anything else. Okay, so that gives you kind of a flavor of what I mean by hard work. Now, the irony here is, why do most people get involved, or the general public, why is the general public attracted to markets and trading? Because it seems like an easy way to make a lot of money. And the irony is, the people who are really successful are tremendously hard workers, and people are attracted to the markets because they want to make money easy. That leads us to the following paradox. You'll grant me that no sane person would think of going into a bookstore, going to the medical book section, finding a book titled How to Perform Brain Surgery, studying it, and going in Monday morning and believe that they could perform successful brain surgery. I mean, no sane person would think that way, granted. However, how many people do you know who would think absolutely nothing unusual about going to a bookstore, walking to the business book section, buying a book called How I Made $2 Million in the Stock Market Last Year, and think that after the weekend of reading this book, they can go in Monday morning and beat the professionals who've been doing it all their lives with all the support and all the experience they have? Right? I mean, it's really the same thing, but yet most people see nothing odd about the second approach. Why such a contrast? What's the answer? And there is an answer to the paradox, and the answer is this. Trading is probably the only world's profession where the rank amateur, the person that knows absolutely nothing, has a 50-50 chance of being right in the beginning. Why? Because there's only two things you can do. You could buy or you could sell. And some people are just going to get it right by probability, at least a few times in the beginning. And that beguiles people to think that trading's a lot easier than it is, because it is possible to get short-term success by pure luck. And that fools people. It absolutely fools people. Can't happen any other profession. You've never trained as a surgeon. The odds of you getting up and doing brain surgery successfully is zero. You never played the violin. The odds of you getting up in front of the New York Philharmonic and playing a successful solo are zero. Any profession you take, the odds of even short-term success are zero. It just so happens trading has this quirk to it that you could be successful for the short term without knowing anything. And again, it fools people. That's the whole point. Talked about trading being a lot of hard work. Now I'm going to tell you something that sounds contradictory. Good trading should be effortless, right? So, kind of, what is this guy talking about? First he says hard work, now I'm telling you effortless. Okay, here's the difference. The process, the preparation is where the hard work comes. The process should be effortless. I'll give you a running analogy. Let's say you picture two runners here. Well, not two runners, but two people. On one hand, picture someone who's completely out of shape, never has done any exercise, trying to run 1 mile in 10 minutes. Okay, have that image? And picture on the other hand, a world-class runner running 1 mile after the other, easy as can be, 5-minute miles. Okay, who's doing more hard work? Who's more successful? Well, clearly the out-of-shape guy is doing more hard work. Clearly the world-class runner is more successful. But the thing is, the world-class runner didn't get there just by getting off the couch one day. He's been training all his life. So his hard work came into preparation. When he's performing successfully, however, the process, the actual process, that has to be effortless. And when he's doing best, when he'll run his best races, when he's really running effortlessly. When you're writing or when you're an artist or anything that's creative, when you're doing it best, it's almost flowing. In fact, it is that term flow is really actually a term that's come to be used. It's even the name of a book, which is a book actually worth reading. And it's true, that is true of trading as well. If it's not going right, you can't force it right by working harder. If your trading is just not working, if you're in a bad period, trying harder, it'll probably make it worse. You can't try harder. You can't work harder. You can work harder in doing more research. You can work harder in trying to figure out what's going wrong. But you can't work harder at trading. You have to probably at that point just ease back. Just maybe not trade. Maybe trade less. Because it's not effortless. And if when you're trading well, it's not work. It's effortless. Again, difference between preparation and process. And I'll give you, there's an interview where this came up with this exact point. And people wonder how I get some of these interviews, and it's not an easy sell, but one thing I usually have to do is I have to tell people, look, I know there's nothing in it for you, but if you do the interview, I will show you the interview. I'm not going to use it. I'm not going to write anything that's untrue. I'm not going to sensationalize anything. And if you don't agree with what I do, then we can't agree how to modify the interview, then we won't use it. And this kind of blows up in my face usually one time per book. Usually I'll have one interview and I end up, in fact, it's actually happened in all 3 Market Wizard books. There's been one interview that I couldn't use for exactly that reason. And so this pertains to one of those interviews. I'm not going to mention any names, but there was one thing in that interview that I really wanted to use, and I said that, and the interview was one of these traders. Let me give you the background at least about what the interview is about. It was a very odd interview. This trader was into some unusual things. So in the interview, we got into dreams in trading, precognition in trading, Zen in trading, some pretty off-the-wall stuff. But it was an interesting interview. And I wrote it up, and I thought it was pretty good. I sent it to him, and a couple weeks later I get a call, and he says, I read the interview. And I said, huh? And he said, it was interesting. I said, yeah. He said, but you can't use it. And why not? Well, turns out he had decided to also go into advising corporations on currency hedging. He had hired a business manager. His business manager read the interview. Business manager had all the stuff about it, dreams in trading and Zen in trading and whatever. Not the corporate image. His business manager said no. He said no, and I was stuck. So I said, look, do me a favor. Just let me use this one little section, and we'll call it Trader X. And he said, okay. So I have that 2-page section in one of the books. And the conversation goes something like this. He says to me, have you ever read Zen and the Art of Trading? And I say, well, I'm afraid I missed that one. And he says, no, I'm really serious. He says, just like in archery, whenever, and I'm going to quote him word for word, when trading, the analogy between trading and archery, whenever there's any effort, force, straining, struggling, or trying, it's wrong. And if you trade, you know those words are true, word for word. Yeah, good trading has to be effortless. Okay, now we come to the concept, which this one is not going to be new to you, but it certainly has to be certainly important, and that is, of course, money management and risk control. So let me just tell you a couple of slants of how the traders look at it. The best way of, I think the best summarization of it is Marty Schwartz. When he talks about trading and need for money management, he says you have to know your uncle point. I don't know if that uncle point is still that term is still used. I know when I was a kid and we fought, one kid bends the other kid's arm behind his back, he yell uncle. I don't know if kids do that. I don't think kids do that anymore today, but whatever. But that's what you have to know where you yell uncle to the markets. That's his point. Bruce Kovner, who at the time actually still a huge trader, one of the most successful currency traders ever, and takes huge positions. I mean, even when I interviewed him, he was trading about $1 billion. I don't know what he trades now, probably multiples of that. So he takes such large positions. He says, whenever I take a position, I know where I'm getting out before I get in. And he said, otherwise I couldn't sleep. And the key point there is, by knowing where you get out before you get in, you make that decision when you have objectivity. Because once you're in the position, you lose that objectivity. And he basically decides where should the market not go if he's right. And he decides that before he puts on a position. I think it's a very good way to operate. Now, money management doesn't have to be really complex. I know there's been books written out there just on money management, and sometimes multiple volumes on money management. But you know what? A simple rule like risk no more than 1% on a trade will get you 90% of the way there. Most of money management is just doing it, just having the discipline to do it. It's not the complexity. There's no rocket science that's required here. It's just that you have to have the discipline to do, which I'll get to in a minute. Now, as far as money management goes, there's some other slants I guess are worth mentioning. Steve Cohn, who's probably one of the world's best traders, and he also hires other traders. And I interviewed him, he has like 50 other traders there. And so he's also not only trading himself, but he's monitoring other traders. He told me like the best trader that he has, the highest win ratio was 63%. 63%. That's the highest one. And he says the point is that most people, even good traders lose a large percentage of the time. And you have to be prepared for it. And he says if you're in a position and you're not sure what to do and it's going against you, he said cut it in half. And if you're still not sure, cut it in half again. And all of a sudden you're down to a quarter of the position and the large part of the problem's gone. The point is just cut it in half will get you out of a lot of trouble in a crisis situation like that. All right, now money management, also in this idea of volatility and risk control, it's, we all here, some of us are traders and some of us are investors. I guess we probably all are investors in some role. And in that, it's very important. It's a very important theme here which relates to the investor side. And that is, a lot of people think about volatility when they're investing, whether, they take higher risk investments, whether it's with a manager or with an individual equity or whatever it may be. And they'll say, oh, well, I'm willing to take the higher volatility because I'll get that higher return. And I can take it. I'm tough. I don't mind the 30, 40% drawdown. If I can get that 50 or 60% return, I'll live through the 30, 40% drawdown. Well, you know what? They won't. I've been there. I mean, I've worked for brokerage firms for over 20 years of my life. And I've sometimes in the role of looking at managed accounts and analyzing what happens. And I can tell you at one time when I did the study at one brokerage firm, when I was kind of working towards picking different CTAs for the firm and monitoring them, I did a study where I looked at the results. There was a statistic that was reported, which was the percent of investors who closed out their accounts at a profit. And I remember quite clearly seeing a number of times that the CTAs had less than 50% of their accounts closed profitably, even when they had all winning years. Think about that. That's because, what do they do? What are the investors doing? They're going in after the CTA has a good run, and then they're dumping it on the drawdown. People who say they can stand a 30% drawdown start sweating bullets at 10%. That's the reality, and you have to be aware of it. And the importance of that is that you won't be around, that investors are not around to get, even if the manager comes back or even if the investment comes back, they're not there to realize the gain. So that 50% return, that 60% return, it won't be there because what happens is people get out during the drawdown phase. And instead of a 50, 60% return, they end up actually with a net loss in many cases. So that is the real danger of volatility. Now, I'll give you a story that relates to that. It concerns a hedge fund manager who unfortunately passes away. And the story starts with a minister who precedes him. And the minister finds himself at the gates of heaven and is met by St. Peter. And St. Peter greets him and he says, name. And he says, Reverend Charles Smith. And he looks it up and he says, okay. Tell you what, why don't you sit there? And the minister looks off to the side and there's this wooden bench. He's a little bit confused. He's expecting to go right in. He says, oh, all right. And he wanders over and sits down on the bench. And he sits there for a few hours. Up comes another man. St. Peter says, name? And the guy says, Robert Wilkinson. Robert Wilkinson. Ah, yes, I see. You're that New York heart surgeon. Sure, we've been expecting you. Please, come right in. And the doctor goes in. A few hours pass. The minister's watching along. Up comes another guy. St. Peter says, name? And the fellow says, Michael Murphy. Michael Murphy, you're the farmer from Iowa. Yeah, we were expecting you. Hope you enjoy your stay. We're delighted to have you. Please, come right in. And the farmer goes in. Minister's watching, doesn't say anything, but just growing a little impatient here. A few hours more pass. Up comes another fellow. And St. Peter says, name? And the person says, David Stevens.
Good morning, afternoon, everybody. I'm excited to be with you. Today is February 16th, Tuesday, February 16th. My name is Nick Lovelace. I'm the founder here at the Super Trader. Let me know, guys, by typing in the chat box if you can hear me loud and clear. That would be very helpful for me. Make sure that everybody can hear me okay. That would be great. Just go ahead and type in the chat box and let me know that you can hear me. Also, for those that are new here today, after you press play on the video player, you're gonna wanna make sure in the bottom right-hand corner of that video player that you go ahead and make sure that your viewer is set to HD settings. And so you can do that again by clicking on the little settings icon and moving it to where you are viewing it in either 720p HD or 1080p HD. I'll show you how to do that real quick. So again, right here, press the play button on the video page. I would expect that you've probably already done that. But down here, that little settings icon, make sure that you set it to either 720p HD or 1080p HD, and that way your quality, the viewing quality, comes in nice and clear. You can expand this window to fill your full screen if you'd like. You'll want to make sure that if you do that and you want to type, you've got to come back in here and type. You've got to lower it and type here. Sorry about that. We're again, that's a feature that we are working on the next version to make sure that you guys can float this chat box in full screen mode. So we will be working on that and have worked on that. So let's go ahead and take a look here at what we've got going on. We ended up our past position on the S&P 500 that expired this past Friday. Let's go ahead and take just a brief look at that and discuss kind of what went on last month. It wasn't a quiet month, but for this particular position, it was extremely quiet. So the position that we had on the S&P 500, we ended up selling the 2045 call option. We bought the 2050, we sold the 1695, and we bought the 1690. I know a lot of people brought in anywhere between 75 and 85 cents of premium, and that we brought in around 85 cents of premium. Let me just pull up the chart here. Now, we ended up getting into this position on the 11th of January, and right back here where my crosshairs are. And as you can see here, the market was extremely volatile in that period of time. We had really large upswings and downswings, but didn't get anywhere near our alerts where we needed to look to manage a position. We didn't get anywhere near those. Again, as you can see here, if I move this down, our initial alert for our short calls was way up here. Didn't get anywhere near it. We did see a little bit of an up move in the market during our trade, and we saw a massive drawdown in during our trade in the overall broad market. But overall, our position worked out perfectly as we like. And again, it goes to show folks that this position is a great position even in markets of sideways volatility. This is a strategy that we created to work well in all 6 of the micro market types: bull volatile, bear volatile, bull quiet, bear quiet, sideways volatile, and sideways quiet. So let's just get going here on structuring our position for February. Let's go ahead and delete these alerts. And again, folks, as always, nothing we talk about here is a recommendation to buy or sell security. And you got to make sure to make decisions that are suitable to you. Folks, this is live. If you have any questions, please speak up. I'm very happy to answer those for you if you've got them. And we'll go ahead and get going here. So, first thing that we want to do is we want to go and find the options that have a 90% probability. We're going to go to our trade tab here. We're going to type in SPX, ticker symbol SPX for the S&P 500 index. I'm going to be trading the March 2, 2016 options. They have 24 days to options expiration. The 2 represents the second Friday in March. So let's go ahead and click on those. And what I'm looking at here, folks, is I'm trying to find the options that have around a 90% probability or around a 10-cent delta. If you don't have this probability OTM, you're going to want to look at the delta. Okay, about a 90 or a 10-cent delta is going to have about a 90% probability. Okay, they were, Hal. Yeah, they were. Okay, so let's go ahead, and I'm looking here at the 1705 strike price. We will get to that here, Hal, in just one moment. Let me structure this and I'll get back to your question. Okay. Alrighty. So what I've done here is, again, I've found the option that has a 90% probability of expiring out of the money. And I've right-clicked on it. I've gone over to sell. And I've just gone up to Iron Condor. Okay, that's the name of the strategy that we're trading here. And that's structured the put side of this position. Okay, we're going to want to scroll down here and find the 90% probability option on the call side, or the option that has about a 10-cent delta. So we're looking here at about that 1995 strike. So let's go ahead and structure that one. So the option that I'm selling here on the call side, 1995. Carol says I took 1710 instead of 1705. Nah, it looks like I took 1705 there, Carol. Thanks for double checking. I appreciate that. But looks like I did put on 1705. Okay, and then I'm going to look to buy the $2,000 strike. The 2000 strike, 2K for our call side. Okay, so it looks like we have a mid price of around 80 cents. I'm okay with anything you know, in excess of around 70 cents or above. I'm going to shoot for around 75 cents here, 75, 80 cents or so. We've got 24 days remaining. This will be one of our shortest trades of the year. So let's go ahead and throw this puppy over into our risk profile. And we're going to analyze some things. No problem at all, Carol. I appreciate the co-piloting thing. And for those of you that weren't aware, that's kind of what we're all about here. You know, that's kind of what these wings represent, symbolic of kind of the wings that you get as a pilot. You know, we believe in co-piloting here, and you know, double checking each other's work and having accountability. And so thank you, Carol. It's not a problem at all. I'm wrong just as often, so that's okay. So I'm going to go ahead and throw this. I'm going to right click on the position, go ahead over here to analyze trade, and we are going to analyze the effect that our trade will have if it drops down to around a 70% probability on those short put or short call strike prices. So let's go ahead and do this. I'm going to come back over here. We're looking at the 1995 call and the 1705. So let's go back to our chart. I'm going to restructure these horizontal lines. So our solid red line represents our short call strike. That's going to be now 1995. Good year. And let's just move our alert level. That's the dash red line. Let's move that out of the way. And then we've got 1705 for our short put strike price. So let's move our solid green line to 1705, not 705, but 1705. Looks like these markets are starting to, we're starting to see a little bit of the volatility come out of the market right now. I would expect still a little bit of sideways chop to higher prices with how these options are being priced, but we will see. So let's go ahead and figure out what our 90% probability looks like. And you can do that, folks, in a couple of ways. There's a really, really neat tool that one of our very own here, Buck, you'll see him in the room here as Robert. Everybody take a moment to thank him for it. But for those of you that would like to, there is a tool that he created. You can navigate to that tool. You don't need to do it right now. That'll take you away from here, but I've gone ahead and put that link in this chat box. Actually, you know what? I will scratch the link that I just put in there. I'm going to put in another link, a direct link to the calculator tool that he developed for us. This is a tool that will allow you to easily calculate the 90% or the 70% probability levels in this particular trade. Some have found it difficult to do that. So what you're going to want to do here, folks, he would probably explain this significantly better than I would. But what you're going to want to do here, folks, is you'll put up here where it says liquidity, go ahead and change your account value. Okay, I go ahead and use about 20% of my account value. You can change that to less as appropriate. So I'm going to go ahead and we'll go ahead and put that in here. Okay, so our date, we don't need to put that in. The spread size, I'm on a $5 wide spread. The put that I'm getting into, I've sold the 1995, I'm sorry, I've sold the 1705 put. And the call, I'm looking at the 1995, and I'm looking for around 75 cents a premium. It's going to automatically go ahead and calculate my risk. You're going to want to make sure, so these gray boxes here, you're going to want to fill those out, all the gray boxes here. So the current price of the S&P, right now we are trading at 1887. I'll just round that down just a bit, and that's going to move around. That's okay. So we're going to say we're trading 1887, and all you got to do is go and find the 70% out of the money put option and the 70% out of the money call option. So let's go and find the 70% out of the money put option. It's right there. We're talking about the 1935 strike, the 1935 strike. So let's go ahead and put that here. I'm sorry, that was the call side. So 1935 on that call side. Let's find the 70% probability option on the put side. We're talking about the 1820 strike, folks. The 1820 strike on the put side. Let's go ahead and put that right in here. Okay, so what happens here is he automatically goes ahead and has structured out what your trade ticket should look like, okay? It should look something like that if you filled it out correctly. If these are the values that you've plugged in, it's gonna automatically tell you, I'm selling the 1995, I'm buying the 2000, I'm selling the 1705 put, and I'm buying the 1700 put. And I want to make sure here that we go ahead and put in the date that our position expires. This one expires the second Friday in March, which is March 11th. So we want to make sure that we do that. We've got 3/11/2016 there. So we've got that plugged in. Okay, and and that is going to be March 2, 2016. Alrighty. Okay, so folks, what it's going to do here is he's gone ahead and he'll show you the alert levels. So there's our short call alert level and our short put alert level. So 2062 and 1587 is where our respective, actually, you know what? Let's see here. That does not look correct. So I have done something here. What did I do? So I've got the short put at 1705 and the 70% out of the money. Oh, I see what I did here, folks. I see what I did. I switched these up here. So we've got 1820, and for the call, we've got 1935. There we go. That looks a lot better. Now our short put alert is going to be 1772. Our short call is 1947. 1947 and 1772. I'm just writing that down. That way we don't have to keep coming back here. Okay, let's head over here to our analytics tool, and we're going to plug those analytics. We're going to plug those 70% probability alert levels here into our price slices. So the current market value right now is right here in the middle. We're trading right there, and right above it, I'm going to plug in my alert level at when my short call strike price should hit around a 70% probability. So that number is going to be 1947. And then directly below the open market value, I'm going to plug in my short put alert level, which is 1772. And on the outer extremes of my price slices, I'm going to put in my actual strike prices for my short call up top, 1995, and my short put on the bottom, 1705. And we're going to want to make sure that we have set for the date here as today's date, which is the 16th. Okay, so folks, as you can see here, I'm going to shoot here for around an 80-cent premium. Right now it looks like the mid price is around 90 cents. But as you can see, if I were to hit my alert level for the short call, I'm going to have around a 97-cent loss per contract, or a $97 loss per contract. So it says $97.24 because I'm showing one contract. So $97 divided by 100, which is how many shares one contract represents here, you get 97 cents. That's going to fluctuate a little bit, but what I want to see is I want to make sure that that loss is no more than 2 times what that premium is, and as you can see, it is not. But if you can see here, if I were to let it go all the way to my short call strike price, I certainly would have greater than a 2x loss than what my premium is, and we do not want that to happen, folks. So my loss is well within the 2 times of the extreme that I want to keep it under control with. I want to make sure that loss is well under 2 times my expected reward, and it is. So let's go ahead and take a snapshot of all of this here, and we're going to go ahead and fill out our little trade log. So I'm just highlighting what those losses would look like potentially if we go ahead and hit those alert levels. Let me copy that and put that into our note here. Alrighty. It's making sense, folks. Any questions so far on anything that we're doing here? For those that are new, some of this may be a little bit foreign to you, but you'll get used to it. And this is about as much work as we do. Everybody here can attest to that. It doesn't get much more than this. We don't do a whole lot. So If we do end up having to adjust a position, we spend a little bit more time on it, but for the most part, we spend about a good hour analyzing, structuring, writing notes, getting into the position, and then we don't do a whole lot with this position for the duration of the month. It's a really nice and laid back positions. Okay, got that, folks. So let's go ahead and fill out our trade ticket here. Again, this particular position does expire on the second Friday in March, which is March 11th. So let's go ahead and put in the expiry date, March 11th. And let's go ahead and put in our short call strike price. We're looking at a 19.95 strike for our call that we're selling. The call that we're buying is a 2,000. I'm just taking information down here from the very bottom on our trade ticket. The short put strike, I'm looking to sell that 1705, and I'm looking to buy the 1700. I am going to be asking for 80 cents of premium. If I get 80 cents of premium, we're looking at a risk of $4.20 because it's a $5 wide spread. If you're not quite familiar with why that is, go to the training, the monthly income training, and to walk you through in the essentials class. I believe it's just week 1. It'll walk you through how we calculate that risk. Okay, so my reward here is going to be 80 cents of a reward on $4.20 of risk. That gives me a 19% return on my risk capital in just 24 days. I believe we have 24 days in this position. So, okay, let's go ahead and do that here. We've got 24 days. Alrighty. So, as far as our, Robert, it's looking like it is filling anywhere between 75 and 80 cents right now. Right now the mid is sitting at about 80 cents. Again, I'm okay with 75 cents, just fine with it here. I'm gonna hang out for just a minute here at 80 cents myself and attempt to get a fill there. And that may just take a moment, but that's what I'm gonna do, is I'm going to hang out there at that 80 cents. 80 cents is certainly on the upper extreme of what we look for. So not surprising that we may not be getting a fill just yet. Okay, so as far as our position management plan, we call it PMP. We've got a profit management plan and a loss management plan. For this particular trading process, we typically, in regards to our profit management, we typically allow these options to expire worthless. As far as our loss management plan, let's go ahead and walk through that. In this case, we would look to limit our losses. Follow along with me here, folks. We would look to limit our losses to no more than, let's look here down at our risk profile. Now again, I'm looking like I'm gonna have around a 75-cent loss on the upper end of the extreme. If my short call hits a 70% probability, looks like I'll have around a 40-cent loss per contract if I go down and my short put hits a 70% probability. I generally tack on about 10 to 20 cents on top of that. So I'm gonna go ahead and say around a 90-cent loss or so. I'm gonna look to limit my losses to no more than about 90 cents. Again, we've got a lot of room for error here. Even when we hit a 70% probability, it's not really anywhere close to what the maximum loss we really wanna see here is. So we observe through the risk profile on the Thinkorswim platform TOS that we would have around a 75, 76 cent loss if the short call strike price went to a 70% probability of expiring out of the money, OTM, which would be around the 1947 price level, as you can see right there. So that is going to be around the 1947 price level here. Also, we would have around a 40-cent loss. I'm going to go ahead and tack on just a little bit more here. We'll say around a 45-cent loss or so if the short put strike price went to a 70% probability, which would be around the 1772 price level, as you can see right there. So we'll go ahead and put in 1772 here, right there. Okay, Joseph J, he says that he is on an iPad and says he does not have audio. What were the short strike prices that we sold today? One thing that you may want to look at doing here, Joseph J, is right here in the bottom left-hand corner, right there, Joseph J. Make sure you click on that little thing right there, Joseph, and that may help you. I know on my iPad sometimes that that button is muted, so if you have problems, just go ahead and check out that. But the short strike prices, if anybody can help him out there and type that in the chat box, that'd be great. Robert, the contracts shouldn't matter a whole lot. Anything over 50 is filled through the floor through a market maker. So you may try to just bring it up under 50 to 49 or below, and you could get into the additional ones. It just costs you an extra ticket charge, but then they're filled electronically, and you don't have to go through a market maker there. And that may be a bit of the issue. Is you're dealing with a human being trying to fill your position versus a computer. And so again, anything over 49 contracts is going to be routed to a market maker there on the floor of the exchange, and sometimes they just are a bit slow about it and aren't as quick for us at doing our bidding for us and getting us into our positions. So that may be the case there for you if you're having a bit of a problem. And again, if I were you, I'd maybe just try to lower it down under 50, and then you can always just tack on the extra ones. I know some people who are really large here, and we've got folks that are trading close to 500 contracts. So I know that there's several of them here that will end up actually breaking their orders up into smaller lots, and there's nothing wrong with that. So, but it does look like it is filling at 80 cents here, folks, and that looks like that is the case. So I don't know if that helps at all, Robert. Try that. That's what I would do. Carol says, why wouldn't the projected dollar loss be about the same on the call and put side? That's a really great question, Carol, and it has to do with the effect of implied volatility when we go up. Now, when we go up, if we were to go up in the market here, what's going to happen is volatility is going to drop, okay? And that's going to have a adverse effect on a credit spread, and that's why you see the effect on that short call side having a little bit of a larger loss there, because implied volatility has dropped off. And it's again going to have an adverse effect on this iron condor, especially if we are selling an option in a low volatility market and it drops off even more. So that's typically what we're seeing there, Carol. When we have the market drop in value, we have an increase in implied volatility, which increases options prices. And because we have two long options here protecting us and hedging us, we are also seeing a benefit from that. And as you can see here, I've got a higher vega on the upper end than I do on the bottom end. I've got a vega which measures the effect of a volatility move. Okay, so again, that's gonna that's gonna affect our position more in a rise in the market. So, okay, alrighty. Carol, I'm not quite sure. You say while making the trade. I'm not quite sure what you're referencing there. If you can, please explain. So I'm going to go ahead and get a snapshot here of our particular trade and where our alert levels are in relation to this chart. Again, our alert level for the short call is going to be 1947. So let's go ahead and move our dashed red line to 1947 there. And I'm going to go ahead and move this dashed green line to 1772, really close to where it already is. We're going to go ahead and move that to 1772. And we're going to go ahead and take a little snapshot of this and put that also in our notes. Okay, so let's go grab that and we'll put that in our notes. Okay. So like I've got that there, folks. Just grab this. And one thing that you're gonna wanna make sure you do, folks, is I watch these things every day for you, so you don't have to. You know, I'm gonna come here every day and watch it for you, again, so that you don't have to. But I do encourage you to set alerts there at these alert levels. I just right click on my line, create alert withdrawing. I'm gonna say, let me know if it crosses that particular line, okay? Let me know if it crosses that particular line. I'm gonna go ahead and create alert there. And also on the bottom dash green line, let me know if it crosses that line. Let me know if the market drops down and goes below that line where my short put should have around a 70% probability. So let's go ahead and put up a time level here. This particular position does expire on March the 11th, right there where that vertical blue line is. So again, we've got 24 days remaining in this trade. Again, how we are setting alerts here at the 1947 price level and the 1772 price level respectively. Again, our short call alert is going to be that 1947 and our short put alert is going to be that 1772. Now folks, just by way of a reminder, if that alert chimes off, we do not panic here. We do not worry, we do not fear. We don't allow our emotions to get control of us. We get in, we come up here to our trade tab, we go and we see what our probabilities are for the short strike that triggered the alert, okay? So if it were to drop down and go down and trigger our short put alert, we're gonna go and check out what our short put strike price probability is. We're gonna go and find the 1705 options and see what the probability is. Okay, and if we are at around a 70% probability, then we will look to adjust the position. If we are still greater than a 70% probability, we're going to observe. Okay, now just because this alert goes off doesn't mean that we're going to have a 70% probability. That calculation is based on the market moving rapidly up to these alert levels or down to that alert level. If it takes several weeks, we're still going to have significantly greater than a 70% probability. So 70% probability is the adjustment trigger, not this alert. Okay, this alert is merely here for us to begin to pay attention because we're not going to have a 70% probability prior to that point in time. Okay, we will not have a 70% probability prior to that point in time. Alrighty, folks. Any questions here on anything that we have done? Hal says the alerts are closer together than last trade. Why is that? Are you referencing, Hal, that our alert is closer to our short strike price? Is that what you're suggesting? Is that what you're suggesting there? I'm not quite sure if that's what you're noticing and picking up on, or if it's something else. Maybe you can clarify there for me. But if it's that, you know, you're going to see that because of implied volatility and adjustment implied volatility, you're going to see an adjustment in those alert levels, and it really all it has to do with implied volatility. And what we're having right now is we are seeing implied volatility shrinking. I can go ahead and put that up here on the screen by going up to studies, edit studies. I'm going to go over here to IV, implied volatility, over here. Oh, where are we at here? Let's go ahead and plug in IMP volatility. And so, in any case, we are seeing that the, I mean, when we put on this trade last time, we had an implied volatility level of upwards around 26%. And so right now it's, you know, around 24%. So we're 2 percentage points below what it was last time. So maybe that's what you're seeing is just that slight change in implied volatility there. But that's going to move around. And again, these probabilities are based on the risk-free bond number, and in addition to standard deviations, a great class for you to go and watch if you're not quite sure on what all the probabilities means is go back to the monthly income training course. You can access that just up here, up above, in additional system resources. You can go up to the training course monthly income and watch the statistics and probabilities classes. That should walk you through a lot of that. But how, again, it has to do with the decrease in implied volatility there. And when that happens, you'll find that your ranges become a lot thinner. In addition to your alert levels, those become a little bit thinner as well. So that's where that's coming from. Any other questions here, folks, on anything that we've done here today? Does all of this make sense? If you ask me where I think the market's going, I will tell you, if I knew that, I'd be sitting on an island right now asking for another refreshing beverage. So frankly, I don't know. I've got my guesses, but I don't know. We broke some very, very key, significant technical levels. I do feel like the market will probably chop around a bit more because of that breakage. Again, what I'm looking at here, let's go ahead and save this. I'm going to go ahead and save this grid here and make sure that I don't lose the charts that I've just made. And you'll be smart to do that as well, so you don't lose any of the charts that you just made. And I'm going to head over here to something that I've talked about often, but this breakage of the S&P. Let me go to a 20-year monthly chart. Yes, exactly right, Ray. Virgin for me, my friend, virgin for me. But so in any case, we did break a very key level here in the overall S&P. As of right now, we have recovered it. But I think that this market may tend to chop around a bit here. It also could just rocket right off of this level, as it has broken it a couple of times. But as you can see back here in that 2011 time period when we had that Euro crisis going on, it still seems like we're having that, plus more crises going on. But right now, as you can see, we did break that level. So far, we have recovered it, and we may see this market head a little bit higher to sideways due to that. And it still hasn't convincingly, it hasn't had any convincingly consistent moves to the downside yet. It hasn't extended that downside move. It continues to get bought up, and buyers continue to step in. So far, so long as that continues to happen here, we continue to bounce or go a little bit sideways. So if anything here, folks, I think that we continue to go sideways to higher right now. But we will see, as of right now, still, I think that we are in a sideways volatile market, and we are not. So in any case, folks, if there's no other questions here, I am going to go ahead and get these notes posted up. I'll go ahead and post the link right in this chat box here. Give me about no more than 5 minutes to get you the link to these notes, and that way you can get these notes. For those of you that, again, want that monthly income calculator tool, I will post that link here again. There is that link to the monthly income calculator tool for those that want that. And then again, give me about 5 minutes. I will have these notes here, and then head over to the open positions log. And that'll take me about 10 or so minutes to get all that there. And you'll be able to watch the recording of this session if you want, plus all of the other sessions from last year in the closed positions log. You can go back and watch trades that went against us and what we did to adjust them, and do all of that good stuff. If you ever have questions, folks, reach out to me or head over here to this Trader Engage log or Trader Engage forum. Appreciate all of you. Love you. It's a pleasure to serve you. Hope you have a great rest of the day. And as always, until next time, trade super.